Hello and welcome to my Accounting 1110 review for the final exam. This pencast is on the topic of Chapter 1. I would like to suggest that you watch the Chapter 1 pencast to review the theory and the important topics covered in Chapter 1. Then I suggest you complete the assignments covering Chapter 1 on my Accounting 11, the homework assignment labeled Review for Final. There are some assignments there for each chapter. I suggest you work these on a piece of paper and then enter your results on my accounting lab for grading purposes. Remember, the final exam is a written exam that you take with pencil and paper, and so you'll want some practice solving questions in that fashion before you sit for the final. So, let's begin with a little theory on Chapter 1. I like to start their final product in accounting. Our goal in Accounting 1110 is to learn how to make financial reports. The financial reports that we make include the income statement, the statement of changes in owner's equity, the balance sheet, and although we don't learn it, the cash flow statement is one of the required financial reports. We can do financial reporting to two groups, really. We can do them to internal users, management, employees, others who might be interested on the inside for how we're doing. We can do financial reporting for external users, those people who do not work for our business and don't have access to our financial statements and can't come up and ask us questions. And it is this group that we're learning to do accounting for, external users. What we are trying to do is to prepare financial statements or reports for them in accordance with generally accepted accounting principles or rules that everyone knows we're using, so they don't need to ask us questions. They know the rules that the financial statements were prepared under. Financial statements also include notes. Well, there is some narrative between the notes and the numbers. Users should be able to determine answers to their questions. These financial reports and financial reporting are overseen by an organization in the United States called the Financial Accounting Standards Board at this time. And they oversee financial reporting and the creation of new generally accepted accounting principles. External users who are familiar with generally accepted accounting principles should be able to use these financial statements, should be able to use them to answer investment questions. They should be able to use them to decide if they want to invest in a business or not, lend the business money or not. It's important that these financial statements be prepared in an ethical fashion so that the users of financial statements can depend on what they're reading. And if they know the rules, generally accepted accounting principles that they're made under, that they can in fact use them to answer their investment decisions. Some of the broad rules that we covered in this chapter are economic entity assumption, the idea that financial statements include information only for the business that they're being made for, so that the external users know if they're reading an income statement or balance sheet for a report for an entity, that nothing else but that entity's financial information is included. None of the owner's personal information is there. Another generally accepted accounting principle or broad rule, cost principle. This is the idea that transactions will be recorded, the amount of money that was actually exchanged in them. If we bought a building for $100,000, that's the amount the building would be recorded for. If we sold something for $10,000, that revenue of $10,000 would be recorded. That we would use the actual cost of the revenue or principal, and not some amount we thought it might be worth. Another example is the going concern assumption. And that is the assumption that a business is in business and will stay in business long enough to complete all of their outstanding affairs. So if you're reading financial statements or financial reports for a business, you know that they won't be going bankrupt or out of business in the foreseeable future, or that it is at least can be reasonably assumed that they won't. Another example would be the monetary unit. I got a phone call there and got distracted, sorry. Monetary unit assumption is that we will record transactions in dollars, because that's the measure of the unit of measure in the United States of America. So we'll record transactions in dollars, assuming dollars always have the same amount of purchasing power. We know that this is a limitation and that some assets might be purchased many years apart with varying degrees of purchasing power. But that fact is ignored in financial accounting. Also worth mentioning at this point that there are international financial reporting standards that are currently being created by an international accounting standards board, and that some of these principles that are currently being looked at may change our current generally accepted accounting principles in the United States. That remains to be seen. In this course, we're going to study generally accepted accounting principles as they relate to the United States. So here then were some generally accepted accounting principles that the author introduced in Chapter 1. Another main topic introduced in Chapter 1 was the accounting equation. The accounting equation will be with you through all of your studies of accounting, and it is in fact a fundamental principle studying accounting. And it is that we can record transactions in such a way that the accounting equation will always stay in balance. The accounting equation is assets equal liabilities plus owner's equity. Assets are things that we own. Liabilities are things that we owe. And equity is the owner's residual interest. Let's assume you bought a $100,000 car, nice car, and that you assumed a $20,000 loan on this. That would state that your equity in the car could be determined to be $80,000, because we know from the accounting equation that all transactions leave the accounting equation in balance. You learned some worksheets that you completed throughout Chapter 1 that had you practice recording transactions in such a fashion that it proved the accounting equation would always be in balance. Those worksheets do not carry forward into Chapter 2 as we learn the double entry method of accounting, so I won't repeat those there. I'll just say there are 4 possibilities for the accounting equation, and we'll leave it at that. The accounting equation can increase on the left-hand side, and if it does, something on the right-hand side must increase. That's one possibility. The right-hand side, the left-hand side can go down, and then something on the right-hand side would need to go down. That's another possibility. You might have an instance where an asset on the left-hand side gets bigger and another asset gets smaller, but you're still in balance. And the other side of that would be that you might have a liability or owner's equity item that gets bigger and another that gets smaller, and you'd still be in balance. These are the only 4 possibilities. As you can see, the accounting equation remains in balance after each one of them. If you feel like you'd like to review this more, review the tables in Chapter 1. We also learned an expanded version of the accounting equation, and the expanded version includes a few more accounts. Let's look at that. The accounting equation is assets equal liabilities plus owner's equity. But the expanded accounting equation breaks owner's equity out into further components. And these are the accounts that we work with for the remainder of Accounting 1110. Assets, things that you own. Liabilities, things that you owe. Capital, the amount of money that the owner has currently invested in the business and a place to record additional investments by the owner. Revenues. Revenues are things that the business earns that result from delivering goods or services to customers. Examples are sales revenue, service revenue, rent revenue, interest revenue. Revenues increase owner's equity. Expenses decrease owner's equity. Expenses are costs of selling goods or services, and they're the opposite of revenue, and they decrease the equity account. You might have rent or salaries or utilities expense. And then owner's draws or owner's withdrawals. I wrote draws. And those are payments that the owner wishes to withdraw from the business. They're not expenses, but they're just money the owner has the right to withdraw and use. That is, after all, the reason they went in business. These items all together then equal owner's equity. Let me give you an example, and you can see it would still work. Let's say we have assets of $100,000, and that we have liabilities in this example of $20,000. Not our car purchase, but a different example. And that I haven't told you what the owner's capital account is, but that I have told you revenues for the business are $5,000. Expenses consumed generating those revenues are $3,000, and the owner withdrew $1,000. Could you still come up with the balance of capital? We have liabilities, and you know that all of these must equal assets. Liabilities are $20,000. Revenues increase that to $25,000. Expenses decrease that to $22,000, and minus another one would be $21,000. So we know what $21,000 is, and we know it needs to equal the total of assets of 100. So 100 minus the 21,000 we can explain means that capital must be the difference of 79. Now let's try it and see if it works. 20 plus 79 is 89.99. 1,000 plus 5 is 104. Minus 3 is 103. Minus 1 equals assets do equal liabilities. If you know you have 1, 2, 3, 4, 5, if you know 4 of the 5 variables, then you can always come up with the fifth, because you know it must equal assets in the end. There's an exercise on my accounting lab where you can practice both the accounting equation and the expanded version of the accounting equation. The next really important thing that you should take away from this chapter is how to create financial statements. In this chapter, we didn't learn how to create the numbers so much as what went on each statement. And we started with the income statement. You'll recall that the income statement lists revenues that a business has earned. It subtracts from that the expenses the business has paid. And the difference between revenues and expenses is then net income. The income statement then shows you how much income a business earned for a period of time. You put the name on the income statement first, and the fact that it's an income statement, and then the period covered. And remember, the income statement is a period of time statement. So you have the name, the income statement, and the period covered in the heading, and then you list revenues and expenses to come up with net income. This then was our first financial statement. Our second financial statement would start again with the name of the business, and then it would list that it was an owner's equity statement, or statement of changes in owner's equity, and it's also for a period of time. The statement of changes in owner's equity shows you the beginning balance from the last period, and then it adds to that two things: investments by the owners and net income. Net income being derived from step 1. And it deducts from that number draws or withdraws, amounts that the owners might have taken out. And if there were a net loss, there couldn't be net income. It will be one or the other. It would be deducted. All of these things are then totaled, and you have an ending balance for owner's equity. So the statement of changes in owner's equity shows its name, the company, according to the assumption that you will only include transactions from the owner, the economic entity assumption. And the period covered will list the beginning balance in owner's equity. Might be 0, but only for the first time. We'll add investments and net income and subtract draws and net losses. You will have an ending balance. That will be the ending balance in owner's equity. The third statement we learned in this chapter would be the balance sheet. Again, it starts with the business's name. Then it lists that it's a balance sheet. And this is the statement that is for a point in time. Just lists the date. As of 5 o'clock of close of business on that date, this is what the business owns by way of assets. And it lists them out. And it lists out the liabilities that the business owes. And then it brings down the owner's equity from above in step 2. And the liabilities and the owner's equity would equal the total. And it would be the same total as your assets, and hence the name balance sheet. These were the main topics covered in Chapter 1. You could now go to my accounting lab and work some exercises that will help you practice these concepts. There's exercises on the accounting equation, the expanded accounting equation, and on completing these financial statements using this format. I suggest that you complete the financials or the problems on paper and then enter them into my accounting lab to be graded to see how you did. Doing this allows you a chance to work problems by hand, and since you'll be required to do that on the final, practicing now is a really good idea. Thanks for joining me for the really important topics from Chapter 1, and we'll carry on our discussion on Chapter 2.